This week, we are coming out with 3 interesting webinars. The first webinar is Building Wealth the Right Way, Process over Prediction, where we discuss the sustainable way of building wealth. And the second webinar is Are You Financially Dependent Without Realizing It, which is a women's only Kodishwari webinar. Join the webinar, click the link below.
2025 was a year when large cap made ordinary returns, mid cap made meager returns, small cap returned negative returns, and micro cap got whacked. 2026 has begun on an extremely volatile note. We are not even 1 month into the year, and what are we feeling? Large cap does not seem to have the strength to pull away. Earnings are tepid. Mid cap seems overvalued. It's being held up mainly by continuous flows of capital into mid-cap mutual funds, and they are buying and holding valuations up. Small cap, on the other hand, has capitulated in January. We are seeing significant weakness in small cap stocks. Micro cap is the weakest part of the stock market and is possibly heading rapidly into a buy zone because valuations are contracting at such a rapid pace. In such a year, should an investor focus on making high returns, which is an aggressive stance, or should an investor focus on not losing money, which is a defensive stance? Most investors in 2025 avoided large cap because they felt they could not maintain an aggressive stance in large cap. If I can't be aggressive in a part of the market, I don't want to put my money there. That's the broad message from most investors. But look at what happened. The investors who said, I can't take the risk of these valuations in mid and small, I can't take the downside risk and face a drawdown in micro caps. For me, large cap is relatively a safer part of the market. Those who took this stance actually did well in that year. They made positive returns. So in a year where everybody is making negative returns, if you don't lose money or make marginally positive returns, you're actually in a better place. Now, how many of you are in a better place on 31st December of 2025 compared to 1st January 2025? Think about it and put your thoughts in the comment section. Whether you are better off in 2025 from where you were at the beginning of the year. Now let's come to 2026. At the beginning of 2026, investors were not quite happy. In fact, it would have been worse had it not been for a late recovery in the indices in December towards the end of the month. So investors are feeling not much money is being made in equity, whereas precious metals have run up so much. And that fear of missing out actually forced a lot of investors to leave equity and go to precious metals, to sell equity and buy precious metals. Now that's a FOMO trade, driven purely by the FOMO factor, which is the fear of missing out. In my opinion, if not losing money was important in 2025, it is doubly important in 2026 because the scope to lose money is much higher and the possibility of losing money faster is real. Because you are seeing the volatility, you saw how in 2 days the market comes down very fast. And you can't compare the Nifty returns to what happens in the micro cap segment or the small cap segment because Nifty may fall 3 or 4% or 5%. But here you'll see a 20% fall or a 15% or a 10% fall, which means this market is definitely not showing ample strength. Meanwhile, the result season is going on. I don't know how many quarters it is since large cap companies beat expectations and beat their quarter-on-quarter profit performance by a wide margin. A wide bid has not happened in a long time. What does this tell you? It tells you that companies are struggling to grow profits at a rate which will justify their valuations. Very few companies are doing that, but those are not the companies which the market fancies. The market fancied companies are actually disappointing investors even after the investors have lowered their expectations and reduced their guidance. So, in such a scenario, it is more important not to lose money than to aggressively try to make money. A defensive stance in 2026 is a much better approach than an aggressive stance. So, for the second year in succession, defense is the best form of offense. Can we end up in a reasonable place like the large cap investors of 2025 in 2026 by maintaining a defensive investment stance? Well, that's the only way you can hope to do that, because I believe that an aggressive stance in buying equities at elevated valuations is not going to help you achieve the outcome which you want to. So you're trying to make higher returns at the wrong time. So a defensive stance, on the contrary, will keep you almost in the same place, but it will keep you confident. Why do you need this confidence? You need this confidence to invest more in equity when the market dips. So if you don't lose much, and you know the market is losing a lot, you're seeing what's happening in the small and the micro cap index, but your portfolio is reasonably flat. Then you get the confidence to invest a little more money into your portfolio. It's important that an investor maintains this investor confidence throughout this year so that at every opportunity thrown at them by market volatility, the investor puts some money into his portfolio. A lot of portfolio investors keep arguing with their portfolio managers, saying that I gave you money, you didn't give me returns. Essentially, no investor is giving a manager money. The money is in the investor's portfolio. The manager has a fiduciary responsibility to manage money. But the investor also has a responsibility to keep contributing money when the markets give opportunity. When the market is throwing opportunity by correcting, when the market is allowing you to buy equities at a favorable valuation when it falls, an investor should not be going around with a measuring tape seeing what is the return at that point in time. Instead, he should use that opportunity to buy what he needs to buy so that later he'll have much more profits to measure and feel happy about. So there is a time to actually judge and there is a time to show conviction. Most people show conviction when it is a time to judge, which is around a market peak, and show judgment when it is a time to show your conviction, which is a market bottom. So when the market is going down, you need to show conviction. Hold back your judgments till the market goes up, because that period between showing conviction and showing a judgment is the investment phase. Don't waste it. And thank you for watching this video.